I'm Motley Fool Chief Investment Officer Andy Cross. At our recent Motley Fool member event in Denver, Colorado, the Motley Fool's Chris Hill talked with analysts Aaron Bush, Bill Mann, and Matt Argersinger about some of their favorite global investment opportunities. Chris kicked things off by asking Matt about a company that's been called the Netflix of China.
All right, let's move on to the stocks themselves, and you guys just sort of jump in. iQiyi.
Yes, iQiyi, a company that actually just came public earlier this year. It's been called in a lot of contexts the Netflix of China. I kind of think of it, and I hate using those lazy monikers because I use them too much, but I'll use another one. I tend to think of it as the YouTube of China more because it derives about 50% of its revenue from advertising on free videos that people watch, and there's advertising with that. And the other 50% is premium subscriptions. And this is a business that last quarter grew its subscriber base 75% to 67 million. It's growing tremendously. It was founded by Tim Yu in 2010. Baidu took a controlling stake in 2012, and then it was spun out of Baidu, or at least partly, earlier this year. Baidu still controls roughly a 60% stake in the business. You look at the market cap of the business, 17.6 billion. And, comparing that to Netflix makes you think, wow, there's some opportunity here because Netflix is about 8 or 9 times bigger. And you look at the market of China and it looks bigger, but there's some competition for iQiyi. Tencent Video is a big competitor. Alibaba also has a online video business. But in my mind, and I think in our minds, iQiyi has the lead. They've got, of course, the Baidu pedigree, the Baidu data and artificial intelligence that's really driving a lot of their content decisions. And in 2017, I thought this was tremendous. In 2017, 42 of the top 50 viewed videos, films, movies, TV shows in China were either owned or distributed by iQiyi. Yeah. So it gives you some indication of their dominance in the market.
It really can't be overstated culturally how different videos and like help videos and things like that are viewed in China than they are in the United States. They are very, very heavy consumers of these exact type of content that iQiyi as dominates.
All right, so the next stock is Ubisoft Entertainment. This is one of the world's largest video game publishers based in France. Their primary listing is on the Paris Exchange, but they have a quality ADR that trades in the US too. So this company is behind some of the biggest franchises in video games, Assassin's Creed, Far Cry. They own the rights to Tom Clancy for games, and there are lots of franchises associated with that, and they have lots of other games too. And this is a company that truly is founder-led. It was founded by 5 brothers. One of the brothers is still the CEO, and several of the other brothers continue to have executive positions at the company. So they've had quite the ride to becoming a $10 billion business. This is a company that has struggled a decent amount until just about a couple years ago, where they really started hitting their stride. Some of their franchises were waning. The gamers were losing interest. So they decided to make a pretty bold decision where they were going to produce less games each year, but double down on the quality of those games. And that actually has worked out incredibly well. So even though they produce less games a year now, and they'll make more games over time, they actually make more money from those games than they used to. And part of that is through digital expansions. Part of that is, just people being engaged for longer. And also, if for many of you who might have invested in Activision Blizzard in the past, this might be a bit of deja vu, but Vivendi until earlier this year had a pretty big position in Ubisoft, and they struck a deal similar to Activision to sell their entire position. The founding brothers are buying in more. Tencent is coming in as a strategic partner, and they're going to have a big share buyback over the coming months associated with that. And this is a company that still has a lot of opportunity. They're going to produce more games. Digital is a huge tailwind. Because they're smaller than EA and Activision, a smaller percentage of their revenue is digital, but gaming is going to be 100% digital. So that's just going to be pure upside. Tencent expanding into China is going to be a huge deal. They have a great partner there. That's also going to help expanding into mobile games, which they have a tiny presence in. Esports, there are just a ton of tailwinds here that I think can make this business a lot bigger over the next decade.
And it's based in France, which, you know, not to trump Bill here on Canada, but you can find growing entrepreneurial founder-led businesses coming out of France.
Yeah.
You know, who would have thought?
Yandex.
Speaking of which,
Ooh, here we go. So Yandex. Hopefully, if are there any Rule Breaker subscribers out there, you might be familiar with this company. This is the leading search engine in Russia. They have about a 56% share of search in China. Russia, and they've done a good job over the years of fending off Google, although Google has certainly gained a little bit of ground in the marketplace. This was a company founded by Arkady Volosh and his partner Ilya Seligovich in 1997, which is about a little before two guys named Larry Page and Sergey Brin started a company in a garage. So this company has been around and was doing search well before Google was. And they've had an interesting rise as a company. They've obviously benefited from advertising, the growth in advertising in Russia, but they've also expanded in a lot of different areas. One of them being, which is Yandex Taxi, which is their ride-hailing business, which recently merged with Uber, and now they kind of dominate the ride-hailing and food delivery business in Russia as well. It's an incredibly volatile stock. Being in Russia, there's always, of course, the threat, and we've seen a little bit of that
Russia.
last week, the threat of Russia. And yet we looked at this business and we thought the risks were worth it. We think there's just a lot of exciting things the company is doing, not just in search, and ride hailing and things like that, but in e-commerce, fintech, video, other areas.
They've also launched something called Yandex Markets along with Sibir Bank, which is essentially, the PayPal of Russia. So they have their fingers in a lot of really great businesses. And Yandex was the one that we really talked about a lot. This is a company that I don't know that any of us would jump up and down with excitement about investing in Russia, but this is a company that is really great in spite of the fact that it's in Russia. And the hurdle for us to put Yandex in the portfolio was rather large.
Constellation?
I love these graphics, by the way. It's really good. Did you
Google
do that?
Images?
I didn't do that.
Yeah, so
Hansen did them.
Constellation Software. I will take a line about this that's sure to be mocked, and I'm not going to make fun of Canada. Constellation Software is the Berkshire Hathaway of software companies. They have they've been around for nearly 20 years. They've had a 25% return on capital and a 20% plus stock return every year since then. And the reason that they've been able to do it is that they have been acquiring other software companies, and they have very specific rules. And these rules might sound familiar to you all. They want companies that are trading at 5 to 6 times sales. They want companies that are founder led. They want companies that have a very long on-ramp in front of them that could benefit from being drawn into a larger company with a certain scale. So this is an amazing company. They did 60 acquisitions in 2017 of small companies, and they're on pace to do that again this year.
All right. Medicus is a small Australian software company. They sell medical imaging software as a service, primarily to radiologists. And so, as you can imagine, doctors, hospitals, they've shifted away from film to digital. But even now, often the systems that help manage all the images, it's often, they have to manage an assortment of different systems. And a lot of times the data that they have to work with is still stored on site. And so it's a very inefficient method for doctors and hospitals to work with. And so Medicus has come out and they've continued to build their software suite around simplifying and bringing together a lot of the different pieces around storing and streaming and sharing and getting intelligence out of medical images. And the technology that goes into this is incredibly complex, actually. And Sam Hupert, the founder and CEO, he owns about 28% of the business. He claims that their technology is 18 to 24 months ahead of the competition. And that shows in the numbers too, because the growth that this company is seeing, they continue to strike big deals around the world. And so a lot of upside for a small Australian company is being able to, scale out of its core market and start to strike big deals in Europe and in North America, and they're doing exactly that. So it's a great founder, great technology. We're seeing great growth. And if this was like a lot of other software companies that we would see in the US, you might imagine, oh, they're probably burning a lot of cash to invest in R&D and scale their sales force. But no, over the past fiscal year, 1/3 of their revenue converted into profits, which lets them invest heavily. They actually pay a dividend in spite of their pretty heavy growth. And this is a company that checks a lot of boxes for us, and I'm really excited about it.
All right, I'm pretty excited about this. Can you say the name of the company?
I'll say the Jazz Tac.
Love it. Close enough. Yume no Machi Souzou Iinkai, which is Japanese, and it means we will build a new village, which is either the most high-minded company name I've ever heard or the dumbest. I'm not sure which. I love this company. This is the Grubhub of Japan. There's some really interesting things that are going on in Japan. It's been a fairly stagnant market for about 20 years. But in the last 5 years, the Prime Minister of Japan has tried different ways to get the country to begin economic growth again. And one of the easiest things that he picked that they could do was to get more Japanese women into the workforce. Now, there's a huge problem. A huge impediment for keeping Japanese women from getting into the workforce is that none of the infrastructure exists for two-income households, right? There are things that just don't exist, like there aren't enough daycare centers. There's just not a lot of things in place. So in that environment in which the government is trying to push households to bring women into the workplace, we have a company that does food delivery. It's a country that is dominated by small mom and pop restaurants. So they don't have the infrastructure in place to do it themselves. This is a fantastic business for the restaurants themselves, a fantastic partner for them. But they only have about 2% of the total population of Japan used any service like a Grubhub. Yume no Machi's service is called Demaikan. So absolutely wonderful company run by and founded by a man named Rui Nakamura, who just was very much ahead of his time in terms of the technology it takes to set up a network like this.